Good morning, goons. We're back after a long hiatus with a special guest here, Brandon Michael. You've seen him before. He is a senior analyst at a top Canadian asset management firm. Brandon, how's it going?
I'm doing great, man. First off, thank you so much for having me. It's great to be back on the show. What a different financial environment since the last time I was on.
The world's changed. It's not the same place.
Exactly. We have the highest inflation in 40 years, the strongest dollar in 20, black swan event with the war in Ukraine, the end of globalization as we know it. And despite all the doom and gloom, I still believe we're in a secular bull market for equities.
Yeah, let's talk about that. I don't know where we're at right now, to be honest.
So one thing that I've always said on this show, and if you're a new investor, markets go up with the least amount of people in them and down with the most. Investor sentiment is the worst that it's been since the great financial crisis. And I'm finding a lot of opportunities in this marketplace.
Yeah, the University of Michigan says consumer sentiment is the lowest ever since they've had that chart.
Yeah, the interesting thing is we're technically in a recession. We've had 2 quarters of negative GDP, but the US still has over 11 million job openings.
Yeah,
Consumer confidence and PMIs are still positive. The unemployment rate's at 3.7%. That's at historical lows. It did tick up from 3.5% in the jobs report on Friday, but the Fed is getting what it wants. The Fed wants a weaker labor market. GDP is moderating. However, inflation looks like it's starting to peak. There's a lot of positive developments. And going back to what we were saying before, they teach you in school the market's sufficiently efficient. I don't believe that.
yeah, the efficient market hypothesis. I'm not a buyer of that either.
I think if you're a long-term investor and you got guts and you got patience, it's a great buying opportunity now.
Yeah.
You just have to have a time horizon that's longer than a day, that's longer than a week, that's longer than a month. You have to have resolve.
Absolutely. This is actually where you're going to get tested. If you got money in the game, what's your convictions about your investments?
Exactly. And I think we should just start flying through a couple of charts here. Sammy, if you can pop up the S&P 500 on the daily time frame.
Good. I haven't seen this in a bit. It's been pretty busy.
Yeah, so we often talk about a cyclical market versus a secular market. So right here, we look at the S&P on the daily time frame. We're clearly in a downtrend. Anyone with eyes can see that. We're trading below the 50-day moving average, which is the blue line. But more importantly, we're trading below the 200-day, which is important because that's the 1-year trend. So we're trading below that by about 10%. The S&P 500 entered a bear market earlier this year. It was down about 25% from the peaks in January. We did, however, stage a breathtaking rally, one that's unlike any bear market rally I've ever seen before. We rallied over 50% retracement off the lows. Obviously, we're entering that weak August to September period. Historically, if you look at the last 150 years of data, this was always a weak period. And we have a little bit of event risk. The market's selling off ahead of CPI on September 13th. We have the Federal Reserve decision on September 21st. Everyone's wondering, are they going to do 50? Are they going to do 75? Are they going to do 100? So during periods of uncertainty, the market typically trades down. But as you can see, it's a negative chart. This would indicate, just looking at this chart and all the other data that we have, that we're in a cyclical bear market. What do you think of this chart, David?
I think the big question is, did we bottom back in May? Because if we bottom back in May, then this is a pretty healthy pullback. I mean, it was expected, I think. If it didn't happen, I would have been worried. Let's put it that way.
Yeah, I mean, we definitely had that kind of waterfall action. I believe it was kind of early to mid-June. I mean, you see those gaps. And at that point, I mean, sentiment was the most washed out that it's been, again, since the great financial crisis. We were just kind of looking for that low. I think if it wasn't for the war in Ukraine, we probably would have bottomed in February and just would have been kind of run-of-the-mill 10% correction. But here we are. We're retesting the lows, which is great. I mean, very rarely do you get that V bottom. We had it during COVID, but I think that was a result of like super loose zero interest rate policy. Now we're getting the retest, and I really think it's how we bounce off of this level. And as we get past those two events that I was talking about, and we head into October, which is seasonally the strongest period from October to April, I think the markets should trade quite well. We have the midterm elections coming up in November as well. And typically, I'm not sure if you know this, the best year of the presidential cycle is the third year, the year after the midterms. And the year of the midterms is typically the worst performance.
When you say the best is the market performs the best in their second year, you said.
Yeah. So the two best quarters, actually, sorry, the three best quarters that you will have during the 4-year presidential cycle is Q4 in the second year, Q1 of the third year, and Q2 of the third year as well. And I believe the average gain during that period is like 20%.
That actually is pretty interesting. Coincides with the bill that Biden just passed recently. We could talk about that in a bit, but the bill, they project that the next 2 years, up until the end of 24, they're going to increase spending by like quite a bit, almost $500 billion. And so like I can see why that would benefit the market. Like this is an infrastructure bill.
Well, it's funny that you say that because I just find that such a paradox. It's very
Mm.
counterintuitive. The Fed is trying to dampen inflation and they're trying to raise interest rates. And what we need is more austerity and not more spending in this environment. I mean, I think the real catalyst is going to be a peaking in interest rates and a peaking in inflation, which we could see. I think we've already maybe seen a peaking of
I
inflation.
think so.
We'll get into that. But Sammy, if you can pull up the weekly time frame on the S&P. Yeah, so this gives us more of that intermediate trend. So this chart goes back to like the mid 20 teens. As you can see, we've been in a secular bull market for the last, maybe 8 or 9 years, depending on how you draw those lines. So you may ask what makes this a secular bull market? Well, while we are trading below the 50 week, which is the blue line, if you look at the purple line, that's the 200 week, and we've defended that as support every single time. And you'll typically do that in a secular bull market.
Yeah, I agree. Even the recent like kind of relief rally we had, that was surprising. I don't know if it was surprising to you or not, but it was pretty surprising to me on its strength and how quick the market turned positive.
I think the market breadth is something that we've never seen in a bear market rally. Like everyone's saying this was a bull trap and that was just a bear market rally. I mean, I don't know. When you looked at breadth and you look at just everything rallying together, that kind of thrust is something that you get typically at the start of a new bull market. Obviously, we have some event risk and we have some seasonal factors kind of weighing on us here, but we're respecting that 200 week. I think until the midterm elections, we're going to have to form some kind of equilibrium pattern. And by that, I think we're going to have to form, some higher lows and lower highs. I don't think it was a coincidence that we tested that 50 week, like bang on. And right now, I mean, I know
Yeah, that
you're
was the 200 on the daily too, right?
yeah, 200 on the daily, 50. I mean, it's the same thing. It's a 4-year average, or sorry, the 200 is a 4-year average. The 50 is a 1-year average. But interestingly, I know you're a man of the Fibonacci retracement. We've retraced exactly to the 38.2% retracement of the summer rally on the S&P.
Really? I didn't check, but that's very
That holds
interesting to
any
know.
significance to you?
Yeah, I mean, the way I see it, like it's pretty rare too. If you retrace to 318 and then we bounce up from there, it's like that tells me it's not just any kind of rally. This is a very strong market. Usually I expect like 618 or something like that. But yeah, if we pull back to like a 386, that's like a lot of strength.
Interesting. It's funny because we respected that 3,600 level. I mean, a lot of market skeptics said we would have to go to like 3,400 and we would have to kind of retest those COVID highs. At this point, I don't think that's happening. I don't think we're making a lower low here. I think it's time to consolidate. We're going to have a little bit of an equilibrium, and then we'll eventually make our ways above the 50 week. The 50 week is the most important factor here. If we can trade above the 50 week, we're back into bull market territory. Until then, we're just in no man's land.
Yeah, I find it. Yeah, there's a lot of bears that say we might have a lower low, but in my mind, I'm like, where's the supply going to come from? Because the way I'm looking at it, like all the loose hands got shaken out already, and I think the market should have priced in the inflation, the interest rate hikes already. So like, where's the supply gonna come from?
Well, the Bears are going to say a lot of things, and they're going to
Mm,
draw a lot of interesting levels here. But I think the most important thing that's really held the market up has been stock buybacks. Like using Apple
mm.
as an example, I believe they're weighting on the S and P is like 7 to 8%. It's the highest weighting that any stock has ever had on the S and P. And this company, I believe they're generating like $150 billion worth of operating profit, and they're using a large chunk of that to return cash to shareholders and buy back stock. So things like that. I mean, you got stocks like Meta and you got stocks like Alphabet. They're buying back their own stock. And that I think is putting a floor on the market here. We are entering a blackout period in a few weeks, which is kind of coinciding with this September weakness. So, weakness over the next few weeks, it's par for the course. But again, as long as we're holding above that 200 week, that's a line in the sand. Still a secular bull market. We're innocent until proven guilty.
I had a quick question. Did you notice if the buybacks kind of accelerated in the last, call it 30 to 45 days? I ask because there's actually a provision in Biden's plan where he's going to tax buybacks, and so I'm wondering if people are trying to get ahead of the that.
That's interesting. It's something that I haven't looked into, but what I will say is that all of the skeptics have been saying that, a lot of companies would be taking a hit to their quarterly earnings and that they'd be suspending buybacks. And we haven't seen that. A lot of companies are actually, reiterating their buybacks and they are buying back boatloads of stock. The only issue is liquidity right now. I mean, when you look at large cap equities, unfortunately, they're a source for cash because they're the most liquid. I mean, look at Bitcoin as an example, too. Bitcoin is the most liquid asset in the world. So, when people, they there's a lot of reason to buy stocks. There's only one reason to sell, right?
Fair
So,
point.
if people need the money, they're going to hit bids, they're going to sell, and that's that's these stocks are being used as a source of cash.
How does this chart look on the monthly? Are we have gotten there yet?
Yeah, Sammy, can you pop up the monthly time frame? Yeah, so this is long term. This takes you back to like the 1980s, right? And we had like probably the greatest secular bull market of all time in the 1980s. The market bottomed in 1982. It's no coincidence. We had the highest inflation rate this year since 1982. So you can generate great gains in the stock market in a period of high inflation. So you could see like that was an incredible rally. Do you see that little blip towards the left side of your chart? Like the first time we tested that 50. Do you see that, David?
Yeah, I see it.
That's 1987. What did the Dow fall in 1987?
Like 500 points, was it?
I think it was 23% almost in one day.
It's like, was that Black Monday?
Yeah.
Yeah,
And
okay,
you
so
just see
500
that.
points.
You just see that, and it's just like a blip on the chart right there. And that's what I would classify as, if you would like zoom in on that time frame, and we would look at the daily time frame from the late 80s, that would be a cyclical bear within a secular bull. And you'll see the same thing in the 1990. You'll see the same thing in 1998, Asian contagion. But then when the bull market topped in 2000, we entered a secular bear market, and you still had cyclical bulls within that secular bear. But
Yeah, we
that
lost.
period
Sorry. Okay.
where not a lot worked. Like you see that double top from 2000 to
Oh
2007.
08. Yeah. Yeah, we lost a lot of investors in 2001 because of the dot-com bubble. A lot of retail went out, which
Do
is
you
interesting. Actually, sorry, because this is interesting. 20 years later, I can make the argument that retail's back and it's unexpected, and they could be the kind of unexpected, unaccounted for party in the market right now.
Yeah, retail's back. Retail's not going away. I think the advent of like high speed internet and like mobile technology and zero commission trading,
Yeah.
uh, that's not going away.
Yeah.
But if you look at this chart, though, the interesting reason, why I can make the case that we're in a secular bull market and why this market has to be bought. If you compare this period to the 80s, during the 80s, support was always at the 50-month, which is the blue line. And we've respected support every single time during this secular bull market for equities. But then if you look at the period of the 2000s, the secular bear market, we breached the 50 and tested as low as the 200, even lower in 2008, 2009. I mean, that was a once in a generation crash, but you get my point. In a secular bull market, the 50 support. In a secular bear market, the 200 is support on the monthly time frame.
Yeah, that's interesting. Really didn't hold on the 50. I just went right through.
Yeah. So, I mean, right here, we're still holding above that 50. Do we have to retest it? I mean, I don't know. I think that it's going to take some consolidation. Not only did we have a price correction, we had a time correction.
Yes.
And if you mark this up to the midterm election, you'll have the moving averages move upwards. You'll have price consolidating, trading within this range. And eventually, those two will, go in sync. I mean, we don't have to touch exactly. We can sort of just hover over it. But at the end of the day, you don't want to buy something when it's so stretched above its moving averages. You want to buy it when it's closer to its moving average. I mean, you're just reducing the amount of risk that you're taking.
So that brings up an interesting question because you've basically taken the contrarian view that we're in kind of a bull market, and you made a good case for that. So are people wrong to be in value stocks right now if they are? Value versus growth kind of debate?
Yeah, that's a good question. I mean, we've talked about this several times on the show. And what I will say is that my viewpoint on this has evolved, actually.
Okay.
It's no longer really value versus growth. It's all about duration. And duration is a term used in the bond market. It really is
Yeah.
the guts of the bond market. So duration is a measure of how sensitive an asset is to a change in interest rates based on the time to maturity. So how long you have to wait for your cash flows. So value stocks are shorter duration because they place an emphasis on short-term profitability, they pay dividends, and they're less sensitive to interest rates. Growth stocks, on the other hand, you have to wait a longer time for their cash flows to come to fruition because they're capitalizing on current and future growth opportunities, and they're more sensitive to interest rates. And in an environment where interest rates are rapidly increasing in 2022, investors have been pricing in, many, many interest rate increases. I mean, if you would have asked anybody last year if they saw 300 or 400 basis points of interest rate increases, they would have said that you were crazy. So investors have compressed their time horizon down to zero. So value stocks have fared quite well in this environment relative to growth. Or longer duration assets have faced the brunt of this. I mean, look at the bond market. If you look at the TLT, the long-term bond market, what's it down? 20, 25%. And that's supposed to be an anchor for the market, the bond market.
Yeah, and I think I don't know what the last numbers are, but most growth stocks are still down like, what, 30, 40, 50% even still?
At the lows in June, I think it was like 60% of the NASDAQ was down like 50%. It was some crazy statistic. And I mean, when you look at the S&P or the NASDAQ 100, that's, different because, we have a lot of those bellwethers, like the Apples, for example.
Yeah. Even Nvidia was down like a lot. And these are like strong companies with strong earnings too. Like
Yeah, these are very strong companies with strong earnings. But like I'm saying, when you compress your time horizon, you compress it so low, people want the shortest duration assets. They want income, they want security, and they want safety. However, 2023 has the potential to be a very interesting year because 2023 can be the year where everyone recognizes that inflation peaks. Everyone sees what me and you see. And the market starts pricing in a peaking of interest rates, and the market starts pricing in interest rate cuts. And when that happens, investors are going to want to put their money towards longer duration assets. We're talking the NASDAQ, growth stocks, Bitcoin, So we could really have a reversion to the mean in 2023. We could also have more of the same if inflation doesn't peak and interest rates continue to go up. But at this point, I mean, you want to have a diversified portfolio, obviously, but I have more of a barbell approach. I mean, my three sectors, you know this. I like technology, healthcare, and renewable energies. And I find between those three sectors, the names that I have, I get the perfect balance of growth, income, and value.
You're also going to get the supportive fiscal policy. Those are the three that's going to be hit in Biden's bill. Those exact three. So you're right. That Biden maybe have set those industries up for quite a rally next year.
Do you want to take a look at yields now? I have the chart of the U.S. 10-year yield.
Yeah, let's take a look. I haven't seen it. We're above 3% now, right?
Yeah, we're above 3% here. Kind of looks like a head and shoulders formation, but we had a break of the neckline. We're retesting those 2018 highs. At the end of the day, I just want to sort of drive the point across that the U.S. 10-year yield is a really important indicator to look at because it's a proxy for mortgage rates.
Mm.
When you look at this chart, what do you see?
Well, I can firstly tell you this chart looks almost like all the other charts, whether it's 2 years or 30 years. But I noticed that this recent rally broke a trend to the upside. So, I mean, when I look at, sorry, no, go ahead.
Because the 2-year is just rallying like crazy. The 2-year and the US dollar are literally the two best charts on the planet.
And here's what I'm wondering: is the U.S. dollar now going to hurt the American economy instead of help it?
It already has. I mean, all of these multinational companies, they're taking hits because, it really isn't a strong dollar as much. It's a really weak euro.
Yeah, and the yen too.
Yeah, really, really weak yen.
I'm looking at this chart and it's like I'm thinking just fundamentals. Like, do we know who's selling? Because I know
we know who's selling. We know who's selling.
Yeah.
It's the Federal Reserve. They're selling now. They doubled their quantitative tightening efforts. They're selling like $90 billion worth of bonds every single month. And they're artificially propping up yields and weighing on the bond market and the stock market.
I see.
Exactly. So, Jerome Powell, I mean, for a guy that was so sure that inflation was transitory, the guy is just super, super hawkish now. He said, Jackson Hole, we were expecting this big speech. He was going to talk about a number of different subjects. And it was an 8-minute speech, just really quick to the point. He's like, expect pain. We're not going to stop until the job is done. The job done being inflation going back to like 2%. So, I mean, do I really buy what Jerome Powell says? I mean, at the end of the day, I judge a person on what they do, not what they say. And Powell, I mean, the inflation's transitory call, that's the biggest monetary policy blunder of all time. That goes down in the history books.
So I find him forming kind of like a really bad pattern where it's like you said, he was calling for inflation being transitory when it was clear to us or everybody else like a month to like 60 days earlier that it might be sticky. And then now he's saying like he's want to raise rates when like again 30 to 60 days worth of data is saying like maybe inflation has peaked. It's like he seems to be behind always.
Yeah, he seems to be behind always, and then when he realizes that he's wrong, he shifts the other way. Like the pendulum just swings, and right now he's full hawkishness.
Yeah.
And we had a weaker than expected inflation report in July. I believe CPI month over month was like 0%.
Really?
Still, I think, what was it, like 8.7%, I believe, year over year. But as these comps start to filter through, these really strong comps, inflation is going to moderate. And Sammy, if you can pop up the chart of gasoline, which is RBOB. So like, this is my favorite charts. This is my favorite chart in the world right now. I mean, gasoline, everyone wants to talk about how expensive gasoline is, but RBOB fell, gasoline futures fell from what, $4.50 to now like $2.50.
Yeah.
And just to tell you my experience, I remember filling up my tank with gas in June. I think it was $2.50 a liter. And I just filled the other day, and it was like, I think 149.
Yeah, I think crude's fallen like 40% from the peak. 30,
Yeah,
40%.
from what, like the 120s, maybe 130 level to like the mid 80s. And
Yeah.
I mean, a lot of that is due to demand destruction, fears of recession. Uh,
Yes.
yeah. And also, summer driving season is, that's also coming to an end. We have more supply coming back on. The Iran nuclear deal potentially getting renewed, although we have more headwinds from the Saudis maybe cutting production. So it's a very dynamic market here. But I look at this and I take this as a big win.
Yes, because what energy is like what 30, no, 40 plus percent of CPI, isn't it? Like it's share of
Yeah,
CPI.
it's
Like
over a third. I know that for sure.
so like I mean so this is what bothers me. Like I bitch about this all the time online. Like you've seen it. It's like I say inflation is synthetic as fuck because it's not like
Mhm.
overall inflation where everything's just going up. It's like no, there's like one giant source carrying the inflation higher than it should be. And what happens when that source normalizes or like goes back, pulls back? It's like
Yeah. You put out probably the most prophetic story on Instagram. I just got to pop it up. I got it on my phone here. You said on May 13th, this was before inflation peaked. Inflation peaked in the month of June. You said inflation is synthetic as fuck. It's the excuse to raise prices well beyond what is normally acceptable. Do not accept it. Do not buy anything that you do not have to. Let that shit sit on shelves. You don't have to wait long. They still have overhead. Let them bleed until they lower prices, then buy what you need, giving them the finger. Man, that was the most brilliant thing like all year, man. So,
I
congrats
was
on that.
so triggered. Thank you. I was so triggered when I wrote that. But then I felt vindicated when what was it Target and Walmart started reporting like lower than expected earnings, and they're like the stock's sitting on shelves. I'm like, well, there you go.
Effect, classic bullwhip effect. The interesting thing is, though, in terms of Walmart, you bring that up, their grocery segment did great. And I think that um, demand destruction is real. I think the Federal Reserve raising interest rates, everyone's 401k is down, higher mortgage rates, that's having an effect on the consumer. And I think people may have not realized what you said back in May, but they're now, by instinct, following what you're saying just through human psychology and their spending habits. I think people are going down the value chain. Um, Restaurants, for example, eating at a restaurant is very expensive. You have to pay for, very overpriced food. You have to pay a tip and tax, HST, when you can just go to the grocery store and for the same price of a nice meal out, you can get groceries for an entire week.
And you still have to drive to the restaurant too.
Yeah, wow, great point. You got to drive to the restaurant. You have to pay for like very, expensive gasoline. Sammy, can you pop up the chart? I created a chart here. I wanted to show the charts of Cheesecake Factory, which was just a random restaurant stock that I chose, and the chart of Loblaws. They're completely inversely correlated.
You're kidding.
So I started this chart March of 2020. Really interesting time to start here. And it's funny that during the pandemic, when no one was able to eat at a restaurant, Cheesecake Factory stock went parabolic. And Loblaw stock, I mean, didn't do a hell of a lot when the market was just, had one of its greatest rallies of all time. And it's funny, February of 2021, when a lot of areas of the market peaked, for example, ARK and the meme stocks and Dogecoin, that's when Cheesecake Factory peaked. And we were in the midst of the pandemic. I mean, nobody was going to restaurants at that point. So I guess people were just pricing in a potential reopening, and Loblaws started going up in February of 2021. And Loblaws has, I think, went up maybe 70% from that time frame. And Cheesecake Factory stock has been down 60%.
It's just crazy. It's actually really like, have you checked out the correlation coefficient? It's probably like 0.8, 0.9. Like, this is ridiculous.
Well, what I did check out, I looked at a lot of different restaurants, a lot of US restaurant chains, and all their charts look the same. I mean, the peer group is trading together. I just thought Cheesecake was like everyone knows Cheesecake. And Loblaws, again, I mean, everyone in Canada knows Loblaws too. It's a big, diversified, grocery consumer staples.
You know, to your point about eating out being expensive, the trend of buying ordering from Uber Eats and all those other things, like Soon as we opened for real, like the sales for those went right back down because it's not cheap. It was convenient. We were forced to do it, but then once we have an option to go to the grocery store, we went to the grocery store and spent our money elsewhere. Like it just dropped right off.
Well, it's interesting that you bring up Uber because I think Uber Eats was what kept Uber's stock afloat
Mhm.
relative to something like Lyft. Like Uber's outperformed Lyft tremendously.
Yeah.
And I think that helped them during the pandemic, while Lyft doesn't have that. So again, I think that's just pretty interesting when it comes to Uber. But now I think it's biting them in the ass.
Yeah, they're also doing groceries pickups, and they were trying to innovate. I'll give them credit for that, but none of it really stuck. Like they introduced the consumer to their services, and the consumer had a good experience, but yet it wasn't sticky. Like they didn't go back for more.
But it's
Just too
very
expensive.
difficult to innovate when you don't already have like a base of profitability.
Yeah.
Like, we look at profitable companies, like Tesla or Apple. And, like Apple wants to get into all these new markets. They want to build a car, they want to build a headset, all this stuff. Well, they're able to because they have hundreds of billions of dollars of cash. They can hire the best engineers. They have a great platform, a great ecosystem. They can do that. But when you're already burning money, it becomes very difficult to compete with some of the incumbents.
Yeah, it's a good point. What else you got going on here?
Another chart I got for you, we're talking about inflation peaking. Well, what about copper? We talk about Dr. Copper. That's like the bellwether for how the economy is doing. I don't have the chart of copper, but it peaked at about, I want to say $5, about a year ago. And now it's like what, $3.40. Well, that's telling us that inflation's transitory. The other chart I got for you is gold. If you can pop that up, Sammy.
Oh, I love talking about gold.
Yeah, so we got gold here. I mean, I don't really know what to think of this chart because gold this year has had the single best environment to outperform everything. We've had geopolitical risks, like we have a war going on. We have, we have a strong dollar, so that's kind of going against gold. But we have inflation. I mean, gold does well in periods of high inflation and low interest rates. So if we look at like what is the real interest rate? The real interest rate um, is the interest rate minus inflation. So let's say interest rates right now are like 3%, going to be 3% in a few weeks, and we have inflation at 8. Well, the real interest rate is -5. That's
Yeah.
an environment where gold should really be thriving. And I believe looking at some of the gold miners, stocks are down 50% from the highs back in April or May. So that is really incongruent. If you're a gold bug, I mean, I don't know what to tell you at this point because the situation is only going to be getting worse for you as the Federal Reserve raises interest rates and inflation peaks. Real interest rates are going to start going up. So,
Well, would you agree that almost any kind of investable asset is kind of driven by a narrative, like a story, like especially companies, right? And how like if people, how many people believe in this story? Well, the story was gold is the ultimate inflation hedge, and then you want to be in gold, right? And it's like you said, this has been the craziest environment of inflation since the '70s, and gold has done nothing.
yeah, gold's done absolutely nothing. I mean, the one thing that I said on the podcast a year ago, a year and a half ago, was that gold will get you 1% per year annualized over the last 200 years of data, right? So if you're trying to get 1% a year, gold is doing a great job and it's hedging you against inflation. The only problem is that you'd be doing much better in any single asset. You'd be doing better in bonds, you'd be doing better in crypto, stocks. It doesn't matter.
Even homes, like if you have any money to park, a gold seems to be like the last resort, whereas like you absolutely have no idea what to do with your money. Then you put in gold.
Well, in this environment with interest rates and with inflation, and you have to spend money to store it, and make sure that it's
Yeah,
not counterfeit and whatever. I mean, it's not verifiable.
yeah.
I'm not the biggest proponent of Bitcoin, but I think Bitcoin definitely is more of a sound characteristics of money than gold is. But Bitcoin also, I mean, everybody last year was saying that Bitcoin was supposed to be a hedge against inflation. And I mean, maybe it is if you look at it on the last, 2 years, let's say on like a 2-year chart. But I think a lot of the, dumb money really put the cart ahead of the horse on that one. I mean, we didn't start seeing the inflation until what, November. The price of Bitcoin's down, 60 to 70%. And I'm not saying that these assets are not going to perform well. I think that if we do get a peaking of interest rates, if we do start to price in some cuts going into 2023, 2024, these assets can all do great. But I'm not buying gold. If I had a choice between Bitcoin, the stock market, and gold, I mean, gold is the last one that I'm going to choose.
Yeah, 100%. It's interesting about Bitcoin too, because I forgot who it was that said it, but they said instead of a barometer for inflation, Bitcoin actually is more sensitive to interest rates and how easily companies can get funded, or how much liquidity there is in the market in terms of money, like how much the money supply is in the market. And I think that's true because if you look at gold's chart, it matches the creation of money quite well, like the M2.
Yeah, well,
And
if you look at M2, I mean, M2, everybody loves to say that Jerome Powell had the money printer going and that we had the largest increase in the money supply like ever or since World War II. But if you look at M2 money supply, we've halted. It's been the sharpest halt in M2 money supply ever. We've never had that in the history of humanity. So I think that we're going to see the effects of that reverberate in the next few years. And I think that those that hold assets will be beneficiaries.
I
Because during
agree.
inflation, assets will go up.
Yeah,
Real assets.
didn't M2 peak a few months ago too, or 6 months ago maybe? Like I know
Maybe
it
6
peaked.
months ago, maybe at the start of the year. But that's definitely, I think, going to be one of the biggest factors for the markets eventually going up.
100%. This is interesting. Gold is so useless.
Yeah. In terms of inflation, I mean, I'm not sure where you want to go from now. I mean,
Hmm.
um,
Let's talk about Biden's bill. The
yeah. So, we've talked about the Federal Reserve and central banks globally trying to raise interest rates to dampen inflation, which is completely counterintuitive in terms of um, what governments are doing. I mean, the monetary authorities are doing one thing, the fiscal authorities are doing one thing. Does what Biden's doing, is that negating or blunting a lot of the effects of the Federal Reserve? Like, what do you think? Where do you stand?
well, first of all, I want to touch on all the governments being counterintuitive or doing counterintuitive things with the inflation. Like you have California giving giving their citizens rebates for gas for the increase in gas prices. So do you understand that it was the creation of money that created this kind of inflationary environment, and then now they're going to give money, just helicopter it to people to kind of combat inflation. Like that literally is throwing fuel on fire, thinking that it'll put it out. It's just ridiculous.
Makes no sense. And even um, the student loan debt, I mean, that makes no sense. I mean, you're owed money and now you're not going to be repaid for that. I mean, imagine if you were a publicly traded company, like let's just say Walmart, and you're like, okay, all of our debts from our customers, we're just going to say you don't have to pay that anymore. We're just going to forgive you for that. I mean, it just doesn't make economic sense. I'm not in favor of them doing any of that. Like, if you're going to have to wipe off debt, somebody has to pay for it. And I think us as the consumer, we're all going to have to pay for it. It's just adding to the deficits that we already have.
So you make a really good point there, because there are actually three people in that picture of student debt, right? It's not the universities forgiving it; it's the government, which is what bothers me the most. Because if it's the universities forgetting it, then they get to eat it. They're a for-profit organization; they get to eat the loss. But because it's the government forgetting it, us as the taxpayers, we're going to eat the loss, while the universities still profit. I don't think that's cool, right? That's what is that teaching anybody?
And then what's next? I think we're setting like a precedent that you don't have to pay back your loans. Like, what's next? Is some big corporation going to come out and demand a big government bailout?
I would argue that came first. We've had how many bailouts? Even as early as in the '80s, right? We've started on that trend of bailouts. Now it just seems like it's expanding to different areas now.
Hmm.
But let's talk about Biden's bill real quick because I just want to talk because we were talking about contradictions, right? So this is just like the overview of it. They're gonna have 437 billion roughly of new spending, right? This is supposed to be a bill that fights inflation. They have $500 billion worth of new spending, right? But they say it's going to be paid for by 737 billion of income generated from their new kind of policies. The
Okay.
problem is their new policies are pretty much speculation, and it's all amortized over 10 years. And it's like you cannot predict what happens even 3 years from now. And so how can you be so sure these are the numbers going to be? I'll give you an example. So they're spending 80 plus $billion, sorry, $78 billion to hire a bunch of IRS agents to kind of beef up the organization a little bit, right? And the thought process is that 78 billion is going to net 124 billion in new tax. I guess people are avoiding taxes, so they're going to claw that money back. But
I
how
don't
can you act?
that. I mean, so they want to tax us more on capital gains. My question is, what capital gains? I mean, in this environment, I mean, are there any?
Yeah, so that's the big chunk of it. There's like 220 billion of that is their 15% minimum corporate tax, minimum tax they're going to kind of enforce. And here's my problem with this policy. It's like they assume that corporations are not going to adjust. They're just going to let them do this, right? There's another one for stock buybacks. You're going to have like a 1% tax on stock buybacks. And it's like, what if they just stop buying back because you're taxing them? Like, do you not account for these things? Like, people adjust.
So what do you think about, I mean, the midterm elections in about 2 months? What do you think? Is there going to be any effect on that? I mean, it looks
Oh
like
yeah.
some political gridlock and the market likes gridlock. Do you think that, eventually, I mean, in 2 years, Biden, if you look at the election betting odds, it looks like he's not going to be in office. Do you think that some of this gets peeled back, or is a lot of this set in stone? Is it just proposed? I have a lot of questions.
Yeah, I have some strong opinions about that because I actually read that stupid 730 page bill. And the more I read it, the more it made me upset. But to their credit, the bill is exactly what I think the Democrats hopes that it will be. It's basically a jobs program, and B, it's kind of like a benefits and subsidies program, and it's all
Hey,
targeted at their voters. I'm sorry?
that makes zero sense to me. A jobs program.
Yeah, they're going because their largest spending component is about 300 billion in renewable energy and EVs and stuff like that. But it's almost all infrastructure. They're going to give the dying automakers $2 billion to buy to build battery factories, right? So that's just one example of what they're going to do. So it is a jobs program. They even say in their bill that they expect to increase jobs by in the millions.
But what the Fed wants is less jobs and not more. So
Less
that
jobs, yeah.
I mean, whether we like it or not, the Fed wants to see people out of work right now. It wants to see the unemployment rate go up. It wants to see the jobs numbers go down. It wants to see a weaker economy so they can get inflation in check. And it just seems like everything that the fiscal authorities are doing is negating everything that Powell's trying to get done. Um, which makes me think, I mean, one side's going to give.
Yeah.
One
Like
side has to give.
like they're going to give $60 billion for the environment. So they're going to hire people to go clean up certain areas. It's like these are some of these are like good things that they should be doing. But again, to your point, it runs counter to what Powell wants to do, which is slow the economy down. And here we are creating like millions of jobs.
So I think that it's good. A lot of these things are great. Like I love, like more spending for like autonomous vehicles, electric vehicles, green energy, whatever. But
Yeah,
this stuff in terms of the supply chain should have been done 5 or 10 years ago.
agreed. This is very true. I
That's a
mean,
big problem. And right now we're seeing, the disruption of supply chains. I mean, that's nothing new.
and they also have little things in there sprinkled for themselves. I found this on page 720 of 730. They're appropriating half
They literally put it right at the end so that you're not going to read it.
so that once you see the 730 page thing, you're like, fuck this, right? But they appropriated $500 million for Homeland Security. Nobody talked about this when they announced the bill, but $500 million for Homeland Security. That's a lot of funding. Like maybe hiring more people, buying more equipment. Either way, it's to stimulate the economy, or it will stimulate the economy, right? This is just ridiculous.
Yeah, I mean, Biden's stimulus bill and, Build Back Better, all of that stuff was just, we didn't need stimulation. And it just seemed like governments just tried to literally push more and more stimulation on us when we actually needed more austerity and more actually spending cuts.
Do you? I don't know if any president has the guts to go the austerity route anymore. I
This
don't know what
world
your thoughts.
because you will not get elected.
Yeah. So that's I think that speaks to most of this contradiction of a bill right now because they're calling it a bill to kind of like curb inflation, and yet there's almost $500 billion worth of new spending in there, all new programs. I
Yeah,
mean,
it's just the bill to cause more inflation. Luckily, the good thing is, as you said, I think a lot of this inflation is synthetic and a lot of this inflation is going to eventually be transitory when we look back, 2 to 3 years from now. I could
okay,
see the
yeah.
inflation rate, moderating once we get the August numbers. I mean, for sure it does with gasoline prices and energy prices and, used cars going down. Maybe next year at this time, optimistically speaking, we're down to 4%, and maybe we can eventually get back down to 2%.
But you
But
think the Fed will be that sensitive? Eh? They'll just start lowering rates as
I
soon
mean,
as
they
the,
already
the
have. They already have. This has been the sharpest increase, in terms of magnitude, sharpest increases in rates ever. I mean, we went from zero,
you know,
like zero interest rate policy, to what's going to be the Fed's funds futures have it at 3.5 to 3.75 in February. And that's where they have interest rates peaking. I mean, I don't see that. I mean, we can all speculate. I think we get a 75 in September, barring any, you know, crazy developments or real weakness in the inflation data. And then I think maybe we get a 25 and a 25. I mean, that's great. That would be, 125 basis points. That would take us to 3.5%.
so here's an interesting thought though. Because of Biden's new spending, they're going to have to fund it obviously with new treasuries, right? So that's more debt. And so like I'm wondering from your perspective, is there an incentive for the Fed to keep raising rates in a way to kind of like, inflate away the debt?
I mean, that's what we were talking about last year. And I think that's where it's going.
Mm.
But I mean, what are the interest payments on the US's like 30 trillion plus, hoard of debt right now? What is it? Like at least over a trillion per year.
It's gotta be. But what's more concerning is like their debt to GDP is about 133%, 138%, something like it's
Yeah, I
ridiculous.
think that to GDP is the highest that it's ever been. And I think that's the difference between here and the 1970s. But
Mm.
in the 1970s, I think it was more structural, and I think this is more cyclical and it's more synthetic. I think it's largely due to COVID. I mean, people say, that it really has to do with the money supply. I mean, maybe a little bit, but I don't necessarily think so because in 2008, we had such a big increase in M2 money supply and inflation was nil. It was literally
Yes.
uh, anemic for the next, 10, 15 years.
So I actually learned this years later. But what happened was like the money was created, but it never left the banking system. Like they created liquidity and bought up like toxic assets, but it never made it to the broader market. Whereas this money was literally $4 trillion. Let's just helicopter it to everybody, and then you see the ridiculous spending that came right after it. It's two complete different stories.
Exactly. I mean, whether we're looking at the retailers or we're looking at oil, you can't shut the taps off completely. And, a lot of people go bankrupt and go out of business and then expect it to, hit that same level of capacity or more. I mean, this year, everybody wanted to spend money on services. Last year, it was all about products. People were, building their work from home setups and, buying computers and buying, clothes and buying stuff that they were really able to like enjoy within their homes. And this year, it's been all about services. I mean, people want to travel. Airfare went up. Actually, airfare was one of the biggest decliners in the month of July, and I think that's going to continue to go down in August. So it's literally products versus services and how consumers are spending their money. But I think that's going to moderate, and I think in 2023 we're going to reach some kind of new normal finally.
So I've got an interesting. I don't have the chart with me today, but I was looking at it the other day. I was looking at some economic data, and consumer spending is up. I think the numbers might be a little bit off, but it's something like consumer income was about like 15 trillion. Consumer spending was like 17, and then you look at credit creation, it's freaking off the charts.
Yeah,
It's
it
like
is.
this.
Yeah, that is worth.
We're not heading in a very good spot, right? So what happens when they have and then with these interest rates, what happens when people suddenly stop their spending because they're broke? They just and the creditors are like, no, that's all the credit you get, and so like spending is just going to fall off a freaking cliff.
Well, I think that it's not the Fed we have to watch out for; it's the bond market. I think the bond market's going to tell us exactly that. The yield curve inverted several months ago. I mean, I think the difference between the twos and the tens is now like I think like maybe negative 20 basis points. So I think that's telling us something about recession potentially. But I think that the bond market's going to lead, and I think the bond market's going to give us that signal, and that's why myself and a lot of other, financial experts as well think that 2023 we're going to start pricing in cuts.
Can you explain the implications of the yield curve, is it inverting?
I mean, the yield curve has preceded, like an inversion of the yield curve has preceded almost every single recession, like ever. But then again, I think it's different in this environment. I mean, do you remember 2019? Do you remember the yield curve inverted in the summer of 2019? I mean, that was a great year for the stock market. The consumer was strong. I think it more so has to do with the Fed, honestly, and just the structural economy that we're in. But I mean, we are technically in a recession. We've had two
Yeah.
negative quarters of GDP, but again, it's like the weirdest recession ever. And the Federal Reserve is propping up short-term yields by, selling short-term bonds. So the inverted yield curve is a factor, but we've been seeing this coming for so long, man. It's not anything new.
I think that's the best point right there. It's that the Fed is kind of like pulling at this because I think if you look at the traditional idea of like the yield, the inversion, it's like people's outlooks, generally speaking, is better in the short term than it is in the long term, and that's why it's scary because you're thinking, oh, 10 years from now it's going to be worse than it is today, right? But then if it's the Fed and they're kind of like poking things around and like kind of synthetically, making the numbers what they are, then it's like, how much can you read into it?
Yeah, I mean, the last few years has been absolutely crazy. I mean, we've had COVID, we've had all these crazy lockdowns. And I mean, even in China, they're still, locking down certain cities. And, we had the, semiconductor shortage. Now we have a semiconductor glut and then everything with the used cars. I mean, it's just, there's a lot of moving pieces here. And I think that, when you look at the 2-year yield, eventually they are going to have to cut, and that's going to lower the 2-year yield. I'm not sure where expectations are going to be for the 10-year yield. I think they're still going to remain elevated because it's going to take a lot of time for the US to rebuild their supply chain here. So I still think that inflation, like, I don't think that we're going back to zero by any means. I mean, we could, but, the world would look a lot different in that scenario. Um, but ultimately, I would see an uninversion of the yield curve, I think.
That's interesting. Looking forward then, what do you see for next year? Because I don't know, I think we actually spoke about this on a episode like way back, and I said like this was way back, and I said like this was after 2020, and I said 2021 is going to be. I think I might have said it in 2020. I said this year's going to be different in that the retail investors had control of the market in 2020, and they're going to get a wake up call in 2021. So because there's an adjustment, right? And I'm wondering if we're going to have kind of sort of the same thing now, where it's like in 22 we have this high inflation environment, and then next year we're going to have like kind of maybe even deflation, because a lot of
Yeah,
things are setting that up.
that's a huge possibility. We're going to see a moderation in inflation, maybe even deflation. And then we're going to start pricing in those cuts. I truly believe that. So I think next year is going to be in complete contrast to this
Yeah,
year, which was complete contrast to last year.
yeah,
I mean, there's a reason why peaks and valleys are right next to each other, right?
yeah. This is clearly a volatile period, but I think what I'm getting at is like there is some predictability in it, and it seems like people seem to overreact and overcompensate, but always too late. And so you can kind of see it happening just before it happens.
I mean, Sammy, can you just pop up the CPI chart? I think now's a good time to look at that.
Yeah, please. Is this core CPI or just CPI?
This is just CPI. So you have, everything here. I mean, you can run through it if you want. I mean, you look at food, that's still like pretty sticky, I would say. But you look at 0% month over month gains. For CPI, you see gasoline going down, and as these comps, as I was saying earlier, as these comps start to filter through, you're going to have a weaker and weaker number. So I think just looking at this, and if you can extrapolate this forward, I mean, the Fed doesn't just want to see 1 month of inflation moderation; they want to see like 3 or 4. So
Yeah.
we get that eventually.
So anecdotally, I know because of my investment in EVs, I know something about the auto market, and the news is that the wholesalers, they have massive amounts of supply in the lots, and it's not moving. Like it's not like last year when people were like rushing to buy cars. It's not moving, and the only reason the car prices are high right now is because they've been kind of shrewdly releasing like a lot of 30 at a time. So instead of releasing it all at the same time, they kind of control the supply, and so that's kind of artificially kept the prices high.
I feel like next year you'll probably get some really good deals on cars. What do you think?
100%, especially fuel cars, because like you even see it now, like there's a rush to fill the market's demand for EVs. And when the Americans aren't stepping up, the Koreans are stepping up. China is like the largest EV market and maker in the world, and they're gonna like fill the void if nobody else does, right? And so like next year, I think there's gonna be a lot of ICE vehicles that are just gonna like flood the market.
Yeah, I could definitely see that happening. And again, that would be with the demand destruction and,
Yeah.
as you're saying, supply coming back online. That would be very bullish for inflation peaking, and that would be bullish for the market. So I think 2023 is going to be a great year. I think we're going to have a shift more so to longer duration assets. I think yields are going to peak. I think next year is going to be completely different to this year. I mean, we're still waiting on the resolution of a lot of different things. I mean, who knows what happens with geopolitics? Who knows what happens with rates and inflation? But when you combine the fundamentals and you combine the technicals and everything that we're looking through, it pays to be ahead of the game.
So I don't know if you could say this, but why don't we leave off with what we're doing in the markets? Do you want to start or should I?
You can go ahead if you want.
Yeah. So I'm I'd rather this is a market where I'm not actively trading. Like when I don't know what's going on, I'd rather do nothing. You know, I think I got that from Warren Buffett. He's like, when you don't understand, just do nothing. And but I haven't exited my positions because a lot of my companies are growth stocks, and then they are kind of setting themselves up for the future, right?
Exactly.
And you kind of never know when that period hits when things just go supernova. Like nobody predicted EVs would just like take off in 2020, but it did. And so you don't want to be out of the market when that happens. But so like I'm heavy into EVs, I'm heavy into semis, so are you. And then so I'm just not moving on these things because I think these are all companies that are establishing themselves for the future, and it could at any moment it could pop off.
These are the best companies in the world. These companies are capitalizing on these growth themes. I'm with you. I'm sticking with my long-term holdings. I'm a long-term investor. I believe in these companies. Obviously, they're facing the brunt because we're in a
Yeah.
cyclical bear market, but I still think that the secular bull market is intact. So I'm sticking with these names. I mean, technicals and fundamentals are really different
Mm,
because with fundamentals, you like a company and the share price goes down, you like the company more, right? It's more of a value stock, right? But in technicals, if the stock goes down, you like it less because that's just classic trend following, right?
that's momentum.
So I think during a bull market, technicals can like guide you higher, and it can kind of, when you're trend following and you just kind of want to, see what's going to have the biggest move. Technicals are great, but in this environment, you got to stick with the fundamentals. You got to stick to like the guts of the company. You got to know like what they're doing, their balance sheet, their financial position. Do they have pricing power in this inflationary environment? What are their growth prospects? How much cash they have, what are their debt levels. I mean, there's a million different things that you can look at. Um,
Yeah.
but during times like these, I mean, why make a move right now when everybody is just rushing towards the exits? I mean, I've said it a million times. I'll say it again. Markets go up with the least amount of people in them and down with the most. So right now, I mean, if you're a long-term investor and you got some cash in your pocket, now's a great time to, maybe dollar cost average or, get some great buys on some companies that you've wanted to hold for a very long time. But I wouldn't be doing anything drastic or panicking at all because, to go back to that chart, we're at that 50 month, we're at that 200 week. I mean, this is long term support. These are the companies that we love. You just got to stick with it. It's been a challenging environment for everybody, but nothing worth having comes easy.
I'm gonna pose one question for you, just because from your that response, I thought it would be interesting. Like, is it possible that the general consensus is incorrect in the thinking that well it's what we go back to like the value versus growth kind of thing, right? The assumption is if you take away credit in the market, then growth has less money to work with, and then they're going to kind of suffer as a result, right? But if you look at a lot of the growth companies, especially the mature ones like Tesla, like they don't need credit. They're profitable. Nvidia's profitable. They're great, right? So I think what if we have this surprising thing where it's like you expect them to not continue growing, and yet they do in spite of the environment. And it's like, wouldn't you
They
want to
are
be in those stocks?
because these are secular themes. These are themes that are in place, whether we're talking about cloud computing or data centers or EVs or the metaverse or cryptocurrency. These sectors are still experiencing double digit, year over year growth. So that's definitely a fundamental positive there. And these companies, they're profitable in the near term. I mean, we used Apple as an example. It's held up well, but you look at Amazon or Nvidia or Meta. I mean, Meta is one of the most profitable companies in the world, yet its share price is down 50%. So I think that there's a lot of inefficiencies in the marketplace. It's not efficient. There's a lot of opportunities. And if you can extend your time horizon to like a year, I mean, I always say have a 3 to 5 year time horizon. If you can do that, you'll do very, very well. You just have to be patient. The longer you can wait, the better that it is. And like some people, they're just not cut out to manage their own portfolio. Because, I think I was looking through like the JP Morgan Guide to Investing last year, and like the average retail return was like 1% per year. And you say, why is that? I mean, the average return for the market, including dividends as well, like 8 to 10%. But it's because they panic buy, they panic sell, they fall for the hype, they check their portfolio every single day when realistically they shouldn't. And that can really bite. So I think during times like these, I mean, you have a thesis, you have to have conviction. I mean, I come on this show and you operate the same exact way. Is I don't want to be like halfway in, halfway out. I want to have conviction in what I believe in. And I have a thesis here and I'm sticking by it.
Great advice. That's great advice. I think it's a great thing to leave off on. Thanks for coming. You got to come back more often, man.
Yeah, man, thanks for having me so much. I really enjoyed it. I always love our conversations. Get a much different perspective a lot of the time, but we're fist bumping all the time. It's we agree on a lot of things here, and I truly believe that we are the contrarians in this market.
We've been contrarians and right for like 2 years. You just look at the videos.
I mean, what does Warren Buffett say? Be fearful when others are greedy, greedy when others are fearful.
That's right.
And I think there's definitely a little bit of a demographic shift in terms of a lot of the smart money that's in the market. I don't think sees the world in the same way that we do when it comes to tech and when it comes to these emerging innovations within, obviously, like a realistic scope of what the economy looks like. So yeah, thanks for having me on the show. I'd love to come back sometime soon.
So there it is. Why don't we have you come back sometime? We'll talk about what your outlook for the future is, like technology-wise and where to be in. Yeah, I'd love that. Awesome, brother. All right, Goons, thanks for watching.
Take care.
Take care.